Here's something that blows most people's minds: you can buy the exact same investment two different ways, and one might cost you thousands more over your lifetime. I'm talking about index funds versus ETFs, and if you're confused about the difference, you're not alone. Even seasoned investors get this wrong. Welcome back to Cashflow Kingdom, where we break down personal finance without the jargon. I'm here to help you build wealth one smart decision at a time. Today we're settling the index fund versus ETF debate once and for all. By the end of this video, you'll know exactly which one fits your situation, how much money the wrong choice could cost you, and why this decision matters way more than most people realize. Let's start with the basics because there's a lot of confusion here. Both index funds and ETFs can track the exact same index, like the S&P 500. Think of an index as a recipe, and both index funds and ETFs are just different ways to cook that same recipe. An index fund is like a mutual fund. You buy shares directly from the fund company, usually at the end of the trading day. An ETF, or exchange-traded fund, trades on the stock market like individual stocks throughout the day. Here's the key point everyone misses: you can have an S&P 500 index fund and an S&P 500 ETF that own the exact same 500 companies in the exact same proportions. The difference isn't what you own, it's how you buy and sell it. Here's where it gets expensive if you choose wrong. Index funds often have minimum investments, sometimes $1,000, $3,000, or even $10,000 to start. ETFs? You can buy one share for whatever the current price is, maybe $400 or $500. But here's the plot twist: expense ratios, the annual fee you pay, are often identical or nearly identical between the index fund and ETF versions of the same investment. Where you really get hit is in trading fees and spreads. Some brokerages charge you to buy mutual funds but let you trade ETFs for free. Others do the opposite. And with ETFs, you might pay a small bid-ask spread each time you trade. Over decades, these small differences add up. We're talking potentially thousands of dollars in extra costs if you're not paying attention. ETFs give you something index funds can't: the ability to trade during market hours. With a traditional index fund, you submit your order and it gets processed at 4 p.m. Eastern when the market closes, at whatever the price is then. With ETFs, you can buy and sell anytime the market is open. Now, before you get excited about day trading, let me be clear: for long-term investors, this flexibility usually doesn't matter much. In fact, it might hurt you because it makes emotional trading easier. But there are legitimate scenarios where this matters. Maybe you want to invest a large sum and prefer to break it into smaller purchases over a few days. Or maybe you're rebalancing your portfolio and want to execute trades at specific times. The flexibility is there if you need it, but don't let it seduce you into making poor timing decisions. Here's something most beginners don't know about, but it's huge for taxable accounts. ETFs have a tax advantage over index funds because of something called in-kind redemptions. I won't bore you with the technical details, but essentially ETFs can get rid of low-basis shares without triggering taxable events for remaining shareholders. Index funds can't do this as easily. What does this mean for you? ETFs typically distribute fewer capital gains to shareholders, which means less unexpected tax bills. If you're investing in a 401k or IRA, this doesn't matter because those accounts are already tax sheltered. But if you're investing in a regular taxable account, this tax efficiency could save you money every year. It's not necessarily a game changer, but it's another point in favor of ETFs for most people investing outside of retirement accounts. Here's where index funds shine: dollar cost averaging and automatic investing. Most brokerages let you set up automatic investments into index funds, investing the same amount every month regardless of the share price. This is incredibly powerful for building wealth consistently. With ETFs, automatic investing is trickier because you have to buy whole shares. If the ETF costs $400 per share and you want to invest $500 monthly, you're stuck with leftover cash or irregular purchase amounts. Some newer brokerages now offer fractional ETF shares, which solves this problem, but it's not universal yet. If you're the type of person who wants to set up automatic investments and forget about them, which is honestly the best approach for most people, traditional index funds might be your better choice. The psychology of automatic investing often trumps the technical advantages of ETFs. Let's talk dividends for a minute.
When companies pay dividends, both index funds and ETFs collect them and can either pay them out to you or reinvest them automatically.
With index funds, dividend reinvestment is usually seamless and free. Your dividends automatically buy more shares, even fractional shares. With ETFs, dividend reinvestment can be more complicated. Some brokerages offer automatic dividend reinvestment for ETFs, others don't. And even when they do, you might end up with cash sitting around if the dividend isn't enough to buy a whole share. This might seem like a small thing, but over decades, having every dollar immediately reinvested makes a real difference in your returns. It's compound interest working at maximum efficiency versus having small amounts of cash sitting idle between dividend payments. Alright, decision time. Here's my honest take after years of investing and analyzing this stuff. For most beginner investors, especially those investing in retirement accounts, go with whatever has the lowest expense ratio and fees at your brokerage. The difference between index funds and ETFs is often less important than just getting started and staying consistent. If you want automatic investing and don't care about trading during market hours, index funds are probably easier. If you're investing in a taxable account and want maximum tax efficiency, or if you like the flexibility of trading anytime, ETFs might be better. But here's the most important thing: don't let this decision paralyze you. Both are excellent choices for long-term wealth building. The biggest mistake is not investing at all while you debate the perfect option. Remember, this isn't financial advice, just my perspective based on research and experience. There you have it, the real difference between index funds and ETFs, and more importantly, how to choose what's right for your situation. The bottom line? Both are powerful wealth building tools, and the best choice is the one you'll actually stick with long term. Don't forget to grab our free investment starter checklist in the description below. It'll walk you through exactly which accounts to open and investments to consider first. Subscribe for new money tips every Tuesday, and I'll see you in the next video where we're breaking down the biggest investing mistakes that cost people their retirement dreams.